Simultaneous marketing and raising of capital is an extraordinary strategy for leveraging the purchase of the company. I'll give you one example of where it was done. We had a couple of executives who had been employed in a tire manufacturing company, and they understood the tire business very, very well, both at the retail level and at the manufacturing level. And they had an opportunity to buy a small chain of tire distribution, tire dealers, I guess you can call them, because you should drive your car in, they take your old tires off and they put new tires on, and you buy the tires that they have to sell. Well, in this particular area where these executives found this particular set of tire dealerships, the dealership was not handling the company that they were part of, that they were employees in. But what they did is they went to the management and ownership of that tire manufacturing company. They said, look, we're going to buy this tire company, this tire distributing and dealer company. They're in an area where we don't have any manufacturing capability, or not, where we don't have any distribution. We'll buy that company, and what we'll do is we will flip it from selling these other tire brands to selling your tire brand. But what we want is some extraordinary accommodations from you that won't cost you a dime. And what they did is they agreed to get the manufacturer to give them a discount on their initial inventory that would take to stock these dealerships with their tires. They then took the tires that were within the company that they just bought, and they sold those to other areas, to the companies that handled those tires at a discount. The discount they got from their manufacturer made up for what they lost on the value of their own, of the tires that they sold out. So what they were able to do is to take the accommodations from the manufacturer who wanted those dealerships to be able to sell their tires in an area that they didn't have representation. They sold them at their cost, okay, to these people. So they didn't lose any money on the transaction. And the folks who were then taking and selling the other tires at cost to the competitors that were out there that would buy those tires, all that transaction cost them nothing to do it. They literally were swapping wholesale manufacturing costs for wholesale manufacturing costs. And they were able to take and get other accommodations from the manufacturer, like deferred payment terms for a long time to pay them back. Anyway, without going through all of the actual technical things that they did, with the support of the manufacturer, they were able to buy the competing or the dealership that did handle their tires. Now, that's an example of simultaneous marketing and raising of investor capital, because they leveraged the capital capability and the resources of their manufacturer, wanted to sell in that area in order to get the resources they needed to buy out the existing company. And then once all of this settled down, they were then buying at the normal prices. They were handling the business of that manufacturer, and they ended up in ownership of a great dealership, and the manufacturer ended up with a dealership network in an area that they formerly didn't have representation. Everybody wins. And by the way, those are the best business deals on the planet. You try and structure your deal so that everybody's going to win. Everybody's going to want to play and do their part when you orchestrate it in a way where the investors win, the manufacturer, suppliers win, your customers win. Everybody wins in your deal. And when you structured it that way, you've got a good substantive deal that everybody gets behind, and it produces a winning formula. Well, if anything that I've said to you makes sense, and if you'd love to have a team of top professionals who literally are going to get this done for you, you're going to want to click that button and get in touch with us so that we can get this done for you.